Welcome, everybody. This is the Rotary eClub of Silicon Valley. We love to bring you the interesting stories of people who are looking at the world in new ways, especially when it runs alongside our interests of entrepreneurship, innovation, and education. But the core for us is service above self, the motto of Rotary International. Rotary is an organization of 1.2 million or so people around the world in 34,000 clubs. And our goal is to make the world around us a better place for everybody. So as a part of the Rotary eClub of Silicon Valley, we search the world for people who've got interesting stories to tell. And today we'll be talking with Dr. Johannes Lenhard of Cambridge University. He is the center coordinator of the Max Planck Cambridge Center for Ethics, the Economy, and Social Change. He's an anthropologist with a variety of research interests. We're excited to have him. And Dr. Lenhard, we are happy to have you with us. I give it to you.
Well, thanks so much for having me, Roshan, and the whole Rotary eClub. I'm very excited, despite it being Sunday, and for you, Labor Day weekend, which doesn't really make a difference for us here in Germany, where I am at the moment. But yeah, I think this is a topic that does fit particularly well with Silicon Valley, where I did research last year to talk to these venture capital investors. The whole point in doing research as an anthropologist on this type of group that lives mostly in Silicon Valley on famous Sand Hill Road, but I also did research in London, where I normally live, and in Berlin, where I am at the moment as well, and a little bit in France, to get a little bit of a broader overview of what's going on in the world of the people who finance technology companies, right? That's what ultimately Silicon Valley does, and venture capitalists more generally, is and specifically my focus there on the ethics of it, and I'm going to explain to you in a second what that means and what it doesn't mean, particularly for the purpose of this talk, is about this more general movement that you will have heard about, called the techlash, right? There's lots of sentiment that is critiquing tech companies like Facebook and Google, and Theranos being another outcry of that a couple of years ago, ongoing because the trials haven't even properly started yet. And what I've been trying to do throughout my career, in a lot of senses, is follow the money. We come to talk about what I wrote my PhD about, where it doesn't seem to fit, but actually that was also one of the sentiments that drove me to research homelessness and the economics of homelessness. But here it's a similar problem for me. We're talking a lot about Google, but we are not really talking about the people that filtered Google and that made it in the beginning, right? The people that gave the first money to them. And I set out about 3 years ago with the goal of making the world of these investors, venture capital investors, slightly more transparent, right? Because I think the system can only really be understood also looking at the economics of what drives it and the incentives and the motivations behind it. Right? So understanding the system that built, financed, made tech, which is on all of our phones and surrounding us on a day-to-day basis. And to establish that in the very beginning, what I mean when I say ethics is not only impact investing, ESG investing, different kinds of tech for good investing. That is one of the bits that I'm looking at. But what I'm mainly focused on is simply decision-making. Why do people act the way they do in the specific structures that they're in, right? What are the incentives that they're following? What are the motivations? What are the goals? That's what I mostly focus on. And in Silicon Valley, that's why this picture is here. There's often this idea that investors invest either in the jockey or the horse, the jockey being the team, the startup team, the founding team that runs the company, and the horse being the market, being the company as such, right? So that's one core paradigm of what drives decision-making. And I basically go one step further, look at how people actually behave and how they act and what they reflect on drives their decisions, and what I then see, being an anthropologist, I try to be as close as possible to the actual action. What I then see drives their decision making. So again, today what we're looking at mostly is not good investing, tech for good investing, impact investing, ESG investing. What we're looking at is mostly the economics, the incentive structures of venture capital and how they're shaping the outcomes. Let me start with a quote that anyone could have said, in a sense, in the venture capital world that I met. It happened to be an American in London who is a GP, a VC partner, reasonably young, very successful, on their second fund, I believe. And he said to me, venture capital is about money. Right? The most important thing that he is chasing, and lots of other venture capitalists, not to say most or all venture capitalists are chasing, are the biggest possible returns. They are, which is the starting point that we need to keep in mind, they are financial investors. They are on behalf of limited partners, LPs, ranging from endowments, pension funds to family offices and high net worth individuals, investing other people's money into startups, and they have to pay back these other people, right? So there is a very simple structure that kind of encompasses this whole world, which is, this is our fiduciary duty, they're often referring to pay back the investors in us, into the venture capital fund, so to speak, as much money as possible, right? And we're trying to manage these returns that we're paying back the VCs. In brackets, how the VCs make money themselves, they get carried interest. So they normally say they're raising a fund of 100 million, they get 2% management fee per year, which they have to pay their wages and rent from, but then the real money comes from, if they make a profit, say they make 500 million of the 100 million fund, they get about normally 20% of the profit that they make. And the rest has to be paid back to the LPs. In a nutshell, what I've been coming to describe what VCs do, which is really my starting point. What do these people do in the world, right? They sit behind desks or mostly also in cafes and meet people and then give them checks, right? In a very simple way, that's how it looks like. But what happens there is obviously slightly more complicated, and trying to kind of capture it in a phrase that has been coined by a venture capitalist, Reid Hoffman of Greylock himself, is they're investing in blitzscaling, blitzscalable unicorns, right? Blitzscaling is a term that doesn't really describe much more than growing as quickly as possible. And that's particularly been the model in the last 10 years. If you're looking at a company like Airbnb or LinkedIn, which he is also one of the co-founders and I believe investors in as well, you come up with a reasonably simple model and then you scale it as quickly as possible with venture capital funding at its bone, being able to then roll out operations, right? With the goal, again, what we need to remember is they need to reach this quote unquote bottom line, which is really paying back LPs the money. And that can only happen in the event of an exit, right? So when they found a company, they talked to experts, they talked to the company a lot, they did quote unquote due diligence, meaning they look at everything that this company has in terms of balance sheets and Excel sheets and technology and the team as such, employees, and they decide to do a deal if they're getting excited about it. And we'll talk about that a little bit more later. This is not a neutral decision-making process where you throw in a little bit of data and then a decision comes out, which we do have much more so in private equity, leveraged buyout, and in investment banking as such. Venture capital is a very emotional business. But what happens once they've done this deal, they invested money, they bought a share of this company because they're equity investors, right? And they need to grow it as quickly as possible. That's what is called blitzscaling. And Hoffman wrote a whole handbook that's called blitzscaling around it, with the goal of growing into a unicorn, i.e. a company that's valued more than 1 billion. And that really is only interesting because they need to exit this company, and that can only happen in 3 ways. The company goes public, IPOs, they're selling the company to a strategic investor normally, or the VC can sell their shares to another investor. Right? And that has to happen, which is the top line in my graph here, that has to happen within the fund life cycle, which is normally about 10 years. So that's, I think, as neutral a description of what, there's no critique in here at all, as neutral a description of what VCs are doing, economically speaking, and kind of the structure that they're part of, right? But again, the simple bottom line is they have to make returns with these investments, equity investments into company. Now, and this is still following Hoffman, who has a very interesting chapter in his book, Blitzscaling, where he talks about the companies, but I take this also to really mean something for the investor. And he goes into quite interesting psychological ideas about what the company may or may not do. And for me, that means what the investor may or may not do, right? You can be a temporary pirate, you can break some laws, you can definitely break rules. You have to really, because what you're doing is creative destruction, according to Schumpeter. You're destroying incumbents, you're building a new business that potentially needs to get rid of some of the old businesses. So you can be a pirate, but ultimately you have to turn into the Navy. That's what Hoffman says. You must never become a psychopath. That's where it becomes illegal, unethical. That's what Theranos did. That's what companies like Uber are very well known for, right? That's why Travis was sacked, interestingly enough, actually, by a conglomerate of different investors led by Benchmark. But the most important thing here is even the VCs see a specific border where behavior is not acceptable anymore. Bad choices, and this is again mostly talking about companies, but I take this to mean also investors have devastating consequences. And these are only 6 examples of where we have seen these consequences, right? All of these companies from Zenefits to Ubeam have had trouble because mostly the C-suite, the founders, have taken decisions and ongoing trouble in the case of Facebook. Google could be on this map here as well, where specific leaders in the company, and what I'm going to argue is that this is also partly, if not driven, at least accepted by investors, and that's why I'm so keen on talking about them, have taken decisions that have not panned out as positively as one would hope for the company, and even more importantly, the impact that these companies have on society. If you think about the whole conversation about fake news and Facebook spreading it, right? That just being one of the issues that we're talking here, or talk about Google's antitrust lawsuits that are going to be going on for the next decade, I would think. And now what people haven't looked at and what people don't really talk about is what are VCs in all of this, right? The investors that have financed these companies in the beginning, that benefit from these companies going public, that benefit from these companies succeeding, what are they doing in all of these different decision-making structures, right? And what this is where my research comes in, really, which consists mainly of me talking to investors. I've spoken over the last 3 years to about 200 different investors, as I said, between San Francisco, where I spent 6 months last year, and here, Berlin, London, mostly GPs, so people that actually run VC funds, have raised VC funds, invest themselves, about these decision-making structures. And what you're seeing is that there's structurally systematic issues in how VCs take decisions. And again, I'm describing this as neutrally as possible and on a level where most people would agree that I'm describing a situation almost factually, right? So as I said before, VCs decision-making, particularly early stage decision-making, when we're talking about companies that just about have a product, they have a founding team, but they might not even have revenue. They definitely don't really have a functioning balance sheet or business model that is projecting numbers 5 years ahead with any kind of precision, right? What we're talking about here is decisions being based on emotions. They're very, very biased. They're often, and Laura Huang at HBS has written extensively about this, based on gut feeling, right? These are excitements driving decisions. These are not just neutral data in, neutral decision out. This is some data in, and that is already colored, and in meaning into the person that is the VC. These are often very small teams, right? They're Benchmark, one of the most famous VCs in the Valley. There are, I think, somewhere between 6 and 8 partners. They don't have juniors. That's it. These are 6 people that take decisions, and they were the first investor in Uber, for instance. They talk to as many people as possible, but ultimately it is really a decision that's based on them feeling good about the company that they want to invest in, right? And the question here might be, what does that lead to? What companies do get investments, right? These are normally very specific companies when it comes to what problems they solve. If you think about it, lots of the VC's investments are actually always somehow about problems that also concern the VC, right? And that ultimately means, and we can talk about that later again, white man. Most VCs are predominantly white men. And that again also speaks very interestingly to the second point I want to briefly talk about. These decision makings are also based on networks. Warm introductions is what really is still the core of how the VCs meet founders, meet possible startups, and what ultimately also helps them to make these decisions, right? They talk to friends and colleagues that they've worked with before. And by doing that, and often they would be set up in networks of, say, the school that they went to. They would be set up in networks of former employers, right? And within that, they're reproducing inequalities. And often that, again, maps very interestingly on gender and racial differences here, right? If we're having predominantly, and we're talking 85%, in some cases, white men being GPs and VCs, what that often leads to, and these numbers are quite solid, both about the US and the UK, we know that quite well, mostly white men are the startup founders that get money, right? Partly driven by these warm introductions and the networks, partly driven by the gut feeling that's based on your own experience. And then something I said before, the kind of companies that get investment are companies that are blitz scalable, so they have to be able to grow quickly and to a certain scale, right? Because ultimately, VCs only invest in companies that can return a fund. And if you've raised about 100 million fund, you need to think about, is this company within the next 8 to 12 years able to make me as a VC 100 million return, right? And that normally would mean 20% of the profit that you get. So this company needs to be able to reach a scale of about 500 plus million. So that means ultimately, where this whole idea of the unicorn came from, VCs have to systematically chase unicorns. Other companies are not really part of the model that works for VCs. And what I want to end with today is certain challenges to this model. So I believe the model that I describe now is how the VC world has worked for the last 10 years. And by the way, there's a fantastic book by Tom Nicholas that just came out last year about the history of venture capital, which is a very young history. The industry as such, depending on how exactly you want to term it, but is really only starting in the 1940s. And he wrote a fantastic history of that, how it developed until about 2000, and that's when I come in, 2010, basically. And that's when I pick up, and the description that I just made is for around the time after that. Between about 2008, the crisis, and now this is what we see look like. The unicorn and the blitz scaling phenomenon is within this short history, again, towards the end of that, right? And what I'm finding out now, and that's where this whole idea of decision-making and ethics also relates to impact investing in a certain extent. What I'm looking at is, and how is this model challenged? What is happening within VC, but mostly outside of VC, that goes against some of these problems that I very briefly teased out when it comes to how VCs make decisions and the consequences of that. One is, and this has not yet really touched on VC too much, lots of financial investors, and this is possibly somebody who sits at the absolute core of what capitalism is about, Larry Fink, BlackRock CEO, one of the biggest asset managers in the world, already in 2018 in a letter to its shareholders said, we have to think more about society. We cannot just invest in anything to make money from money. We have to think about what this investment actually does in the world, right? And that is related to something which, again, somebody who is well known to anyone who studied anything related to economics or management, Michael Porter, a management guru who published already in 2011 that stakeholder capitalism is going to overtake shareholder capitalism. So it's not just going to be about the owners becoming richer by what happens in the capitalist enterprise or the investors. It has to be more globally thought through, including the environment, and that takes us to the third point in a second, and the employees, for instance, right? And that's something that we're seeing with Google. Google is struggling a lot over recent years with its employees. They're on the street because of certain sexist, racist problems within the company, right? So there is already, within the tech company world, we can see that things are changing there. And then another force, which I think is coming at us with full force over the next generation, is consumers are just starting to think differently. They don't just want to buy anything as long as it's cheap anymore. They do think more about the environment. They think more about the kind of production of goods in particular. They think about the companies that they're buying from. They're not just willing to buy anything. And this is obviously embodied by somebody like Greta Thunberg, who's specifically worried and concerned about climate change as such. And then another thing which has obviously, particularly in the US, driven change to a certain extent already in all kinds of societal areas is the Black Lives Matter movement as such, but more generally also a concern that, and that takes us back to one of the points I raised about VCs mostly being white men, an increasing diversity has to be represented in decision-making powers, right? Not just in workforces, but also, for instance, among the GPs, right? And Alan Hamilton, Backstage Capital founder, just very recently said exactly that. When the Black Lives Matter slowly also tickled into the VC world, she said, look, I have all of these portfolio companies that are founded by Black men and women. They're there. There is no excuse about, oh, we can't find good companies. No, come here and hire people into your VCs that then can also see these companies, right? Because as I said before, you're biased, and that is something that is very hard to change by your upbringing, by your education, by your own experiences. And as a white man, you're much less likely to invest in, say, a Black woman than another Black woman. And the Black woman, from her side, is also much less likely to reach out to you as a white man. But what I'm seeing is that there is change happening here that is not yet fully trickling into the VC world, but is already at the border of it, right? Other investors are changing towards, say, ESG policies. Other investors are much more concerned than VCs to a certain extent when it comes to stakeholder capitalism. And some of this we'll see end up being about whitewashing, greenwashing, as we did see about 20 years ago with corporate social responsibility. They're saying they care, but they don't really. So that is also something that we need to be careful with, but there's surely a certain drive outside of the VC community that is slowly also touching on it, which I'm seeing the system that I described, VCs investing in blitzscalable unicorns, slowly changing. And an interesting last point, data point I want to mention when it comes to that, to close, is the SoftBank disaster we saw last year, right? Unicorns, some people, like Bill Janeway, a mentor of mine and teacher at Cambridge, said the unicorn bubble is basically bursting right in front of us because SoftBank's unicorn chasing didn't quite work out, right? WeWork, lots of the startups that SoftBank invested in, lost insane amounts of valuation. Lots of unicorns as such aren't unicorns anymore. So there's a slow rethinking in the VC world that we're seeing with places like Indie VC having a different operational model, where different types of VC is as alternatives slowly coming up. And I think it's very important to, first of all, make transparent what VCs are doing and then figure out what the consequences of their actions are. And then in the second step, see how that's changing. And that's what I'm trying with the work and the book that I'm writing about it.
Excellent. Thank you so much, Dr. Lenhard. I want to get us to questions very quickly. Let me do introductions. Here in the Silicon Valley in Northern California, Sandy Stabile, who is with the membership team on our district. My name is Rushton Hurley. I am the charter president of the Rotary eClub of Silicon Valley. And in Germany, we have Manu and Henri. Okay, good evening for you guys as well. I'll start the questions from a bit of a simplistic economics point of view. You know, I look at what you talk about related to the idea that there are these subjective barriers to being open about possibilities of people from different backgrounds as they bring companies forward, and I accept that what you are describing is in place. Does that not also create an opportunity for someone who says, I want to invest in those people who are getting overlooked because they have good ideas and the other people aren't seeing them? I'll jump in. Is that opportunity something that you've seen in your research?
Yeah, absolutely. Yeah. And overlooked is, I think, a very good word to use here, Russian, I think. More so than, and I've just been writing something about that, minority or subgroups or underrepresented. Overlooked is exactly the right word because that's what it is. And you're right, this is not just starting, but there is companies out there that say are run by 2 women GP, and they say explicitly, we only invest in women because only about 10% or about 15% goes to female-led and mixed teams of VC money, generally speaking, right? So there is a massive pool of people that don't get or haven't gotten money historically that I can make money with, right? It is still, in an interesting way, driven by the same motive. There's actually an opportunity to, as you say, go into markets that have so far been totally overlooked, because they're catering to populations that VCs are not normally looking at, where there's complete new potential to again start company or found companies, start companies, get investment in there, and make money from it for your LPs, right? And the same is true when it comes to any of the groups that normally and historically have not gotten the same amount of money, absolutely. And we see that specifically in the US. There's quite a few new investors that are starting out with a very specific thesis that I'm investing in a specific group, I'm investing in a specific kind of founder, and more so and slowly in Europe as well.
Very cool. I know Manu, you have a question. Welcome, Manu. You know, we're not getting your audio for some reason. Let's stop. You are unmuted, but let's check that. If you can figure it out quickly, just say so. Otherwise, add your question to the chat and we'll share it that way. While we're waiting on that, Dr. Lenhard, I know that you've done a lot of research on homelessness. Here in Silicon Valley, we have quite the homeless problem. I assume that there are some interesting ties in there somewhere. If you have encountered things like that, I'd love for you to speak to them.
Yeah. So as I briefly mentioned before, I did my PhD, and that is work that continues actually at the moment. I did quite a bit of work again during COVID on the impact of COVID on the homeless population in the UK. But I spent 2 years in Paris trying to understand how homeless people survive. And then after about 8 years of spending a lot of time again as an anthropologist, I spend most of my time on the street, volunteering in different organizations, trying to really see the world as much as possible, as much as that is somehow possible for a researcher through the eyes of a homeless person. I switched to a different topic that then, at least in San Francisco, somehow caught me again, right there together with homelessness, right? I also then, when I lived in San Francisco, volunteered in one of the biggest charities there called St. Anthony's, and try to understand a little bit more how the two are in fact related to a certain extent, particularly in a place like San Francisco, where it's so blatant that you have these insane amounts of wealth being created very recently over the last 50 years or something, right? And this insane homeless issue, right? That is so, very rarely, the only other place where I have seen it so vividly is LA, actually. They must be related, right? That is the immediate intuition, right? So if you look into it, there's an interesting, and perhaps that is the one data point that I want to talk to you about. There's an interesting difference between homelessness in San Francisco and say homelessness in Paris or London. Lots of homeless people, the majority of homeless people in San Francisco are from San Francisco, right? That is very different in London and Paris, where lots of homeless people are migrants. They are often migrants to the city, but they are even more so often migrants to the country, right? Lots of homeless people in Paris are not French. Lots of homeless people in London are not English. That is different in San Francisco. And what that at least lets us assume is that lots of these people are homeless partly because something in San Francisco has changed. And one of the major things that has changed recently in San Francisco, recently meaning the last handful of decades, is housing stock has been becoming very, very short, and housing prices have become very, very expensive, right? That is a direct link. That is, if not to say the most important link to homelessness, right? There's a structural problem here which I think has to do with specific zoning laws as well. You can't build up San Francisco. That is simply not possible according to the local laws. You can't build unlimited amount of housing. We're also sitting on a peninsula. There's a very logical connection between lots of people moving in earning a lot of money, being able to pay rents, and the people that are already there being pushed out, right? So that is the most straightforward connection that I can make here. And then you start thinking a little bit further about, say, the attitudes of tech people, right? Libertarianism being very, very widespread, at least these days. And there the idea is obviously, these people are responsible for themselves. We don't have anything to do with that. If they can't survive, they have to leave, right? And that then makes it even more complicated, right? I met quite a few, and that was possibly the most unpleasant interviews that then turned very quickly into heated conversations. VCs, both young and old, all of them, again, without exception, moved to San Francisco. Both of them actually not even from the US, telling me, yeah, I don't know why we are dealing with these homeless people here. They should just we should just build something somewhere closer to Sacramento and just push them there. We can keep San Francisco for ourselves and we push homeless people. And there's then again, once you've established that homelessness is growing, partly because housing stock, rents interacting with the tech population moving in, then the attitude makes it even worse in a sense.
So Monica's question actually builds on a comment you made as a part of that answer. The difference between, for example, homelessness in San Francisco and homelessness in Paris. And he asks, do you see different patterns in terms of venture capital between the United States and Europe?
Yeah, so I did partly do multi-sited ethnography, which is what it's called when you're not only researching something in one place, but in several, to figure that out. What exactly is the difference between how they do VC in Silicon Valley, particularly? I will spend a little bit of time next year in New York to also see whether there's a slight difference between East and West and Europe, right? And what I ended up doing mostly, which is why I have a hard time speaking very specifically to that question, is figuring out the commonalities. How does VC really, in a very straightforward way, how does it work, whether it's there or here? Because we know so little, which is really another motivation of why I'm writing this book now. And I'm writing this for a popular audience, basically like ours, not for an academic audience, because this industry is so completely intransparent, right? But let me perhaps say one or two things about possible differences. One, linking to the change that we've been briefly talking about when it comes to, say, something like diversity and inclusion. I think this is partly because America has had historically conversations about, say, racism longer anyway than Europe. Europe, in a certain sense, is not too reflective on that. I think in Germany, lots of people would still think, oh, racism doesn't really exist here. It's obviously absolute bonkers. But the conversation, the reflection has happened in a much more sustained and much longer way in America, for sure. And that has then also led to something like the Black Lives Matter movement coming up several times, ongoing, basically, ongoing pressure onto systematic issues, most recently again. And I think there's a definite difference between the speed that something like diversity and inclusion as a practice that is becoming accepted also in venture capital funds, as well as, by the way, limited partnerships, is driving into the VC world between the US and Europe. Europe is lagging behind, basically, in very simple terms, when it comes to, say, understanding that diversity and inclusion doesn't just mean, oh, we need some women in our team, right? That's kind of the first established idea that people buy. It goes much further than that, and intersectionality is a question that I think very few Europeans, independent of the industry, think about and understand, and there's definitely much more progress being made much more quickly in the US, right? And when it comes to the actual workings, to go back to something slightly more fundamental perhaps, of the industry, Europe versus the US, Europeans, and again, the sample that I have is Germany and the UK, so there might be slight differences within Europe even, and in a sense, the UK is somewhere in between because there's lots of Americans that come to the UK and kind of start VC there as well, so interconnections there. But generally speaking, Europe is much less risk-taking as the US is. You get lots of stuff funded in the US that Europe wouldn't look at, right? Lots of German investors in particular, and I think that is partly still because the industry here is even younger than in the US, right? If we are talking about VC starting in the 40s in the US, mostly with family money, like the Rockefellers, kind of starting a VC fund and then stumbling into funding a whole industry. So this has only really happened in Germany in the 2000s, right? So the kind of personnel that you now have in the US, lots of entrepreneurs turning into investors, right? They've gone through the journey themselves. They know what it means to build a company. We're only really at the start of that in Germany. Lots of the VCs in Germany are still investment bankers, consultants. They might have worked in the startup. Very few of the VCs, and again, this is starting to change. Cherry Ventures, for instance, has quite a few entrepreneurs. Most of the partners there are actually entrepreneurs themselves, but that's still the exception in a sense. So they don't really know what it means to start a company themselves, right? And that often comes with not understanding that it is important, not to say crucial and necessary, to take risk, right? So the German mindset, and again, crudely speaking, we still have the consultant mindset. I'd much rather safely make my 4x return than the potentiality of losing everything, but possibly making 150x return, right? That's much more likely to happen in the US than here. And that means the ideas that you're getting funding for, historically speaking, in the US is very different from here. Much more risky stuff that the Europeans wouldn't look at. What then happened a lot, and that's partly, again, also based on the founding history of the German venture capital world, is, oh, that worked over there? Great, you just take that over here. We know kind of how it works. We need to adapt certain things because the culture here is slightly different when it comes to the consumers, but that's going to work here as well, right? There's always more of a, we need to kind of dance around it until we've reduced the amount of risk to the extent that we are willing to take.
Got it. Well, great material. As we always do, we will continue talking to you after we finish the recording. If you are visiting us, please do two things for us. Register your attendance at the form below where this appears on our meeting page. And at the bottom of the page, there's our discuss section. Please let us know what you thought of the program, of the meeting, and we hope that you'll engage our members in the ideas that they are sharing there as well. As we always like to do, we hand it over to the speaker for the final word. So Dr. Lenhard, to you.
Yeah, again, thank you very much for having me, Roshan, and Manu for organizing all of this. There's perhaps one thing that I wanted to say at the very end, which is this idea of following the money has been very powerful for me. And I think it's always worth looking behind what's happening in the foreground, right? The background is often driven by economics, which some people are afraid of, but actually Manu and I studied together at one point. We did learn a little bit about economics, but I'm really a social scientist. And following the money is pretty straightforward. You just basically run behind the dollars, right? And try to understand the people, right? And that's what we need a little more of, right? Particularly when it comes to these investors that make decisions that kind of affect all of us on a day-to-day basis. Right? If you do want to talk about this, do reach out to me. I'm always very, very keen on talking to as many investors or people that know about the industry as possible. And the same is obviously true for homelessness.